everyone. Today we'll learn how to invest $1,000 by dividing it into 50 small, manageable portions. Let's get started.
Imagine you have a pizza worth $1,000. We have to cut it into 50 equal slices. Each slice will be $20. Today's entire video will revolve around these slices. First and most important step, emergency fund. This is your financial life jacket for car breakdowns, medical bills. Out of this $1,000, we will set aside 15 slices. That's $300 for our emergency fund. You shouldn't put this $300 in a regular savings account, but in a high-yield savings account. This means you'll earn more interest. Let's say HYSA is paying you 4% annual interest. If you deposit $300 for 1 year, you'll get 300 times 1. The biggest return on an emergency fund isn't money, it's peace of mind. It saved you 20% credit card debt, so that's a return too. Now let's talk about the future, retirement. It's boring to think about, but it has the greatest power. We'll use a Roth IRA for retirement. The magic of it, you deposit money today after paying taxes and then never have to pay. So we'll put 15 slices of our $1,000, that's $300, into a Roth IRA. This is the graph of compounding. It starts slow, then it goes up like a rocket. The formula is A nai P Akar. Assume you're 20 years old. $300 earns a 7% average annual return. After 45 years, by age 65, Where should we invest in a Roth IRA? In an index fund. Imagine it's a bouquet. You get the entire market in one. Diversification.
The main advantage of index funds? Low fees. High fees eat into your returns. Always look for a low expense ratio.
Now let's talk about medium-term goals, like buying a house in 5-10 years. For this, we'll use a regular brokerage account. Of this $1,000, we'll put 10 slices, that's $200, into this brokerage account. In a brokerage account, we'll buy an ETF, like VTI. It's an index fund, but it's bought/sold in the stock market like a stock. If you invest regularly, say $50 every month, you'll buy at both market highs, that reduces average costs.
The best investment? In yourself, in your knowledge and skills. So we'll set aside 5 slices, $100, for a self-improvement fund.
This $100 will pay you back in online courses, books, or certifications. Measure its return on investment by your salary increase.
Suppose a $100 course increases your salary be $1,000 annually. Your ROI, that's cost of investment.
Here, and finally, something you like. We'll use 5 slices, $100 for ethical investing or charity. You can invest this money in ESG funds, which invest in good companies, or you can give it to a charity. Look, your $1,000 is now distributed. Emergency fund, retirement, growth, self, and ethical bets. Remember, the higher the return, the higher the risk. HYSA is safe, stocks are volatile. Your portfolio balances both. If your money is lying under the mattress, inflation steals it. What $100 buys today won't buy in 10 years. That's why investing is essential. If inflation is 3%, then after 10 years, the value of $100 will be approximately 10, this is approximately 74. Time, not money, is your biggest investment asset. Start early. $100 at age 20 is many times more powerful than $100 at age 40. How long will it take for your investment to double? Rule of 72 tells you. Divide 72 by the annual interest rate. 7% return. Your asset allocation should change according to your age. If you're young, more stocks. If you're nearing retirement, more bonds. Check your portfolio once a year. If stocks have risen too much, sell some and return to the original plan. This keeps risk under control. A good credit score gives you loans at lower interest rates. It can save you millions. Maintain it while investing.
In a brokerage account, if a stock is at a loss, you can sell it to get a tax benefit. This is called tax loss harvesting. Advanced strategy, but useful. A 1% fee eats up almost 25% of your total returns. That's why low-cost index funds are so good. You can diversify your portfolio with assets like REITs, in addition to stocks and bonds. When the market falls, people panic and sell. When the market rises, people rush to buy. Both are wrong. Stay calm and focus on your long-term plan. The goal shouldn't be get rich. The goal should be build a $100,000 portfolio in the next 10 years. This is a SMART goal. The best trick?
Automatic investing. Money is transferred directly from your bank account to your investment account every month.
The secret to investing is not earning more, but spending less. What's saved gets invested.
A $5 latte every day seems small, but if invested, it could become $30,000 in 30 years. Small things eat up your future.
See? One coffee is taking away your $1.8 million retirement. Think about where you can save.
Health insurance and term life insurance are also investments. They protect your entire financial plan from collapse.
Someone will come and tell you they'll make you a millionaire in a week. Run away. Wealth is built slowly with discipline.
Calculate your net worth every year.
This will show you your financial progress. It's a report card of your financial health. How much money can you withdraw in retirement? There's a rule of thumb, 4%. If you have a $1,000 portfolio,
Your financial plan isn't set and forget. Life changes, goals change. Be sure to review it once a year.
So remember, 15 slices emergency, 15 slices retirement, 10 slices growth, 5 slices ethical. You've become a balanced investor.